When we talk about the biggest highway robberies, especially on the accounting spectrum, you can't forget to name the most infamous of all time, the Wolf of Wall Street, emulating the Stratton Oakmont reality. The main cast consists of Jordan Belfort, otherwise known as the mastermind behind Stratton Oakmont's illicit plans. His role was played by none other than Leonardo DiCaprio. Beside him, Danny Porosh, one of his closest friends and his Robin, if you will, in this mischievous scheme, was played by the impressive Jonah Hill. Jordan Belfort's wife at the time, now known as Nadine Macaluso, was a character that really voiced their opinion on the wrongdoing of her husband's company. The role was taken on by the admirable Margaret Robbie. Lastly, we have Mark Hanna, also known as one of L.F. Rothschild's most superior stock traders, one Jordan Belfort looked up to in his brief time with the company, which later on went bankrupt. This firm role was played by Matthew McCaughey. Stratton Oakmont was founded by none other than Jordan Belfort in the year of 1989. The company was located in New York, Long Island. It started as an IBTF, otherwise dealing with a select group of banks, insurance companies, and pension funds. In essence, the firm was busy trading to company-oriented lenders, but after 10 years of service, in 1989 they decided to sell to substantial private investors, aka the average citizen of America, and this is when Jordan Belfort took over the company. The company employed 1,378 employees before the seize operations took place in December of 1996. Belfort had changed professions throughout his career, from pursuing a dentistry degree to selling meats and seafood as a salesman. He finally committed to becoming a stockbroker in 1987, where he later took his talents to his own firm, Stratton Oakmont, in the late 80s and early 90s. Stratton Oakmont turned into an investment firm through the 1990s and ultimately strived off scamming middle to low class investors. Prior to the buyout of the firm, Belfort had initially opened a franchise of Stratton Securities, later becoming an investment firm. Belfort, as well as Danny Porosh, checked substantial amounts of their capital through the pump and dump scheme. The plan was a micro-cap stock fraud, which through falsely positive statements created a fake narrative. The reason for this was so they could end up targeting the top 1% rich in America, as they'd never buy penny stocks. At first, he was targeting the middle class with worthless stocks, then added a 50% fee to the stock's prices, which he secretly owned and sold to make profit. The brokers working within the company had helped inflate stock prices, therefore Stratton would sell its own holdings in the stocks for an increase in bank and equity. Therefore, when the salesmen on the phone would quote-unquote dump their overshared values, the price falls and the investor is losing a lot of money, resulting in a hefty amount of commission reaching the salesman's pockets. In other words, the scam was constructed and has defrauded many shareholders, which led to the arrest of several executives and closing the firm in 1996. Aftermath of the incidents were quite devastating for Belfort and Company. During their pump and dump scheme, the firm was in a semi-constant examination from the National Associations of Security Dealers from 1989 and beyond. Almost 7 years later, in April of 1996, the New York District Business Conduct Committee had closed down any principal retail transactions for a full year. To put it in another way, all purchases of goods and services charged to the credit card, excluding those with cash advances, balance transfers, and fees charges, are terminated from use. This is another way of putting a bank account on freeze, resulting in equity and bank not being able to increase, and drawings for personal use are and were invalid. 3 years later, in 1999, both Belfort and Porosh were indicted for securities fraud as well as money laundering. As expected, they pleaded guilty and were sentenced to 7 years in prison, respectively. The manipulation of stock was placed upon over 34 companies, but due to their cooperation with prosecutors, their imprisonment was shortened. In an accounting course, let's look at some of the calculating stats. In 1999, when Belfort's scheme was fully tallied up by law officials, it had come out that he'd stolen over $200 million in assets from the 1,500 clients that Stratton Oakmont as a company dealt with on a regular basis. As much as this money was made off corrupt schemes to scam investors, Jordan Belfort racked up an enormous net worth of nearly $90 million. In the $90 million that Jordan Belfort had made, he bought assets like commercial buildings, a private jet, a yacht, helicopter, sports cars, and much more. The IFRS that were violated included mostly the cost principle and the revaluation model. The reason being, stocks prices were modified and the reverse splits on the stocks caused asset values on the market to differ. In essence, It acts more of a trading scandal than an accounting one, as it was mainly diminishing their clients' capital rather than their own. And we can't forget about all the tax that Jordan Belfort and company had to pay with all the hefty assets and services that they were buying. On the ethics sides of things, Jordan Belfort ran an illegal business, which is unethical on the sustainability of a company, as well as it was solely for his own benefit, throwing others under the bus. The moral of the story is, don't steal and be the best salesman you can be. Thank you.